There's a pretty critical test for the Healthcare Services ETF. So first off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we go here to the healthcare sector. We do see that it is, on average, slightly underperforming the S&P 500, from the lows. And we do see that there's a substantial underperformance vis-a-vis highs. So we go here, and this is the Healthcare Services ETF. This one has a 56% gain, which is pretty decent, but there's been a 4% pullback so far. So let's look at the chart. So this is the long-term picture, weekly data points. So the ETF is from Spider, and XHS is the ticker. So we have seen a very, impressive move here from the low. There's been a huge demand for, healthcare services. Obviously, that's had a very positive effect here on this ETF. The reason why it is pretty critical at this point, that is due to the purple 20-week moving average. You see that as long as that moving average holds, the bulls are basically longer term in control. The moment we lose it, there's a tendency for the selling to accelerate. Here we lose the purple 20-week moving average, bears really get nasty. Here we lose it, and you see that it becomes resistance. We reclaim it, bulls are back in business. Then we lose it, and we have a protracted period of very messy trading. And guess what? That moving average has been very critical ever since, the lockdown low. Purple 20-week moving average. And we are testing it very vigorously now. So there's been, 3 weeks now of us really goofing around there. And last week, even though we did close higher, you do see that the bears really are trying to break that support because they can clearly look at the history themselves. And it's pretty clear that it's a very important level to break if you are a bear. The RSI has cooled down a bit. The PPO is still rather elevated because this has been a rather historical move here. So let's go here to the daily data points. So in this instance, we have the blue 100-day moving average. Surgical test here, surgical test, bulls get into business. Here we try to go down and then the bulls just in before the market and just start running upwards. So it's a very key technical level. So we did close momentarily below, and then the bulls get back into business. So it's clearly a very important technical level. The important thing now for the bears is to make sure that the green 50-day moving average, which was support for a protracted period, that the bears want that to continue to be a resistance, because that is going to increase the probability that they will be able to break here the blue 100-day moving average. The 20-day has now turned negative. We do have a bit of a cross here, so we have a situation in which the bears have gained leverage. I would still say that the bulls are still in control as long as these key levels hold, and if they hold, it could make sense to have a bit of a bullish lean. But if they do break, then there could be some very decent bearish opportunities. So let's actually look a bit here at the seasonality, because what is interesting, if we look first at the last 5 years, so August, September, October, the coming months, they tend to be weak. 7 years, August is the weakest month. 9 years, the last 9 years, that is, August is the weakest month, both in terms of how often it closes lower, and also the average loss is bigger. It's the biggest loss we have for a month. And over the last 11 years, all the data we have, we do see that August is the weakest month. So it only closes higher 44% of the time. So definitively there is something interesting about August, and if we look here at September, even though it closes higher 60% of the time, the average loss for September here, minus 0.4, is pretty similar to what we tend to see in August. So the seasonality, it is leaning clearly bearish. Looking here at Finviz, we draw, these trend lines, support. So that is the key level to watch here as far as trend lines go. If we do break that level, then it's time to really consider some bearish opportunities. However, if it continues to offer support, then that would be bullish. Because in that instance, you would have a situation where the RSI has cooled down, and also the PPO, and you could have sort of like not really a value play, but at least a pullback play, because there's the tendency for the bigger investors to rotate out of overbought sectors and subsectors into those who have seen more pullbacks, because that pullback, it creates a buffer. When we compare the XHS, the healthcare services ETF, with the XLV, which is the broader healthcare ETF, the beta is a bit higher for healthcare services, so there is more volatility. The price earnings is slightly higher, but they are very, very, very similar. The big difference here is definitively when it comes to dividend. So it's 1.34% for the broader healthcare ETF, but only 0.18% here for the XHS. So basically, yes, there is a dividend, but it's so small that you can't really at all make a dividend case for healthcare services. So here you can see the breakdown of the holdings. You see some pretty clear differences here. So if we go a bit further down, here's the sector breakdown. Market cap is much more balanced with the XHS. So if I were to sort of sum up my take here for the XHS, we do have a very clear level to watch. I think that has historically, ever since the inception of this ETF, been that very clear arbiter of whether the bulls or the bears are in long-term control. So as long as the purple 20-week moving average holds, I would give the benefit of the doubt to the bulls. But if it breaks, the history is pretty clear that the overwhelming number of times in which it does break, it usually is a bad sign for the bulls, and it could create some very decent bearish opportunities. So there's that. So let's quickly look here at the S&P 500 in the remaining time we have. So yeah, looking long term here, if you look here at the PPO, we haven't been this far away from the red 200-week moving average since the dot-com bubble. So, and the dot-com bubble, it resulted in a multi-year bear market. And you can see that this rally from the lockdown low has been very, very, it's been like a rocket ship. So yeah, obviously, objectively speaking, we do have a bubble. It is just the way it is. And even though we have had a bubble, it's easier to see that, of course, in retrospect, because at this point, right, when we have completely recovered, the lockdown plunge low, that's when it made a lot of sense to assume that the central banks would sort of ease off the pedal, to sort of have some dry powder, and we did see a bit of a correction. So throughout this basically bubble rally, it has made a lot of sense to have a market neutral approach, because you need, of course, you can't look at this and make a conclusion about the situation here, or even here. Because the big danger of a bubble is that it creates this great sense of complacency. People think that you can always just buy the dip and be happy about that. However, if you do a historical study of of stock market bubbles, you will clearly see that they are extremely dangerous and best suited for market neutral strategies.